Hello, my name is Robert, and I'd like to welcome you to today's webinar, International Tax Lunch, Pensions as Foreign Trusts. Please note that this is a webinar, which means audio over PowerPoint only. For the NASBA and CBA requirements, you will receive 4 attendance checks every hour. The attendance check will pop up over the webinar. Click the OK button to receive credit. Before we begin, there are a few things to note about the webinar platform. To your bottom left, there is a feature called Class Chat. Please feel free to use the Class Chat to talk with other online attendees about the content. The chat is not monitored. To your top right, there is a tab called Ask the Instructor. Please use this tab to ask any content-related questions, and feel free to ask questions anytime throughout the webinar. To the left of the Ask the Instructor tab is a tab called Group Form Only. Please fill out the form if you are viewing with another person so that everyone receives credit. Now let me introduce our speaker. Haojin Zhang graduated from the University of California, Berkeley in 2007 with a Bachelor of Science degree in chemistry. He has a JD from Hastings College of Law in 2012. He worked as a patent agent in the interim. Haojin joined Hodgin Law in 2013, where his work ranges from corporate cleanup to tax analysis of decades-old trust documents. He enjoys analysis of private corporate structures, intercompany transactions, and income, particularly in the context of CFCs and PFICs. So let's get started and welcome Haojin Zhang.
Hey everybody, Phil Hodgin here, and welcome to the monthly Hodgin Law PC International Tax Lunch. We do this every month on the second Friday of the month at noon Pacific time. You can listen in online over the phone, or you can watch the thing we recorded and post it to YouTube later. This month's topic is pensions as foreign trusts. U.S. citizens living abroad, as well as foreign persons who immigrate to the United States, will often have foreign pensions. And U.S. tax law really doesn't know what to do with these foreign pensions. They frequently do not behave as qualified plans the way you'd expect a domestic pension to operate. And so Haoshen this time is going to talk about when you can recognize that a foreign pension fails to behave like a qualified plan for U.S. tax purposes, how you report it on pieces of paper that given to the IRS, and what the tax results look like for the taxpayer. So our speaker is Haoshen Zhang. He is an attorney here at Hodgin Law, and you can find his bio on our website at hodgin.com. If you have questions during the presentation, just type them into the chat box, and Haoshen will see them, and he'll select a few of them at the end if he has time for a Q&A session. More generally, we always welcome comments and questions afterwards, so if you have some questions and follow-ups, just send an email to Haoshen, and he'll be happy to answer them. And if you have some general topics about how we can make these presentations better, please send those along as well. Anyway, that's it from me. I'll turn it over to Haoshen for the presentation.
Hi everyone, just a slight note on the questions. These set of slides are divided into sections marked by really large and mostly blank title slides. I'll be pausing at each title slide to look at your questions and answer them if there are any, so feel free to ask questions at any time they come to mind. All right. Today, we'll be talking about pensions as foreign trusts or other stuff. Here are the topics we'll be talking about. Is this foreign pension a trust, or is it something else? Number 2, if we know that the foreign pension is a trust, is it what is called an employee's trust, which are subject to special rules different from ordinary trusts, and rules for reporting contributions, the growth of the pension, and reporting distributions. Right. We'll be working with 3 specific pensions as hypotheticals belonging to 2 taxpayers, and let us introduce them. Here's taxpayer number 1. He is a U.S. citizen, and he lives and works in Sweden. And his employer has provided an ITP2 pension for him. And I'll get into what ITP2 means when we start talking about what is this pension. But just keep that name in mind for now. It's a very common thing in Sweden. Here is taxpayer number 2. He's a green card holder, and he works and lives in the US. Previously, he had worked in Hong Kong and the UK. In Hong Kong, he is the beneficiary of a master trust scheme, while in the UK, he had a self-invested personal pension, abbreviated SIPP or SIP. Now, let's talk about whether these things are trusts or are they something else. Here's the definition of a trust, or copied from the Treasury regulations. I won't read that back to you, but I'll give you a few seconds to read through it. Now, this definition has a few elements that we would analyze to determine, is this arrangement a trust or is it something else? And we'll apply to, and I'll show you what these elements are for when we get to apply them to each pension. So let's begin with the Swedish ITP2. But before we really apply the criteria for trust, let's get familiar with what a Swedish ITP2 is. It's an employer-sponsored plan for those in the industries. It's a defined benefit plan, meaning the benefits are based on final salary and amount of time in service, and not an accumulation of balance. There are in fact 2 ways a Swedish company can fund an ITP2. One is called book reserves, meaning they mark a certain amount of money on their balance sheet and say, this much is what we need to fund the pension we promised to pay. Let's not spend that. That doesn't always come true because these is actually still part of the company's assets, and if the company starts doing not so well, the creditors can grab them. Or they can pay premiums to an insurance company, essentially buying an annuity. One note, the ITP2 is only for those who were born in 1978 or earlier, and it's based on the birth date, not time in service. Ironically, the ones born after 1978 are beneficiaries of an ITP1. I don't know why 1 is later than 2, but that's how it is. And ITP1 is a defined contribution plan, so it works differently than the ITP2. Let's look at the book reserve funding method and see if it's a trust. On the left column, I've laid aside the criteria need to check whether this thing's a trust. And on the right side, right column, I've laid out, is this true or not? So the first is, in a trust, there has to be a trustee who takes title to property. We don't have that here because the company retains title to the balance sheet. And is it to conserve or protect it? The answer is yes, for the employee's retirement. Is it for beneficiaries? Well, yes, it's for the employees. And is it under ordinary rules applied in chancery or probate courts? The answer is no. There are very little rules about the rule is basically the company has to mark an amount on the reserve that's to provide for the pension, but that's still the company's asset. And they can spend it in a year for themselves as long as they replenish it later, or if they go bankrupt, the creditors can take the reserves and the employee's out of luck. This is very different than the trust, where the trustee can't dip into trust assets for its own purposes. And if the trustee goes bankrupt, the trustee's creditors cannot take the trust assets. So the result is, no, we don't have a trust, and this is just some kind of deferred compensation, deferral from year of service to retirement specifically. So, what about a company that funds the pension through insurance premiums? Well, is there a trustee that takes title to company? Well, the money no longer belongs to the employer. It now belongs to the insurance company. So that's potentially true. Is it to conserve or preserve it? Yes, the money is there in the insurance company's hands for retirement, though it's a bit uncertain on whether the insurance company is really conserving it for the employee's retirement. The insurance company will actually invest the money for its own account and then just promise to pay an annuity to the employee based on the contract. So the second one, maybe. Yes, technically, maybe not. And is it for beneficiaries? Well, yes, for employees. Is under ordinary rules applied in chancery or probate courts? The answer is no. It's managed under insurance companies' rules, and they're somewhat different from the trustees. The result is it's probably an annuity, variable or fixed or traditional, though it's not, depending on what the insurance company is selling, you might end up with an investment account rather. Okay. We have come to a title slide and we have a question. The question is, what does under ordinary rules applied in chancery or probate courts mean? This is something the IRS has not provided details on, but the basic idea is this arrangement is run in a way that's similar to how trusts should be run in the U.S. There are a few elements to look for. One is, who is the trustee holding this asset for? Is it for its own benefit or is it for someone else? And the way you usually tell about this, there are a few ways you can answer this question. And unfortunately, these are weighed factors rather than black and white. Number one is, if this person that's holding the asset goes bankrupt, can a creditor seize the assets they're allegedly holding for the employee's retirement? If the answer is yes, usually you don't have a trust. If the answer is no, you might. The second one is, how does the trustee benefit from income from these assets? So let's say you give this third party, say, $100,000, and this third party goes and buys some bonds. Who gets the benefit of these bonds? That is, no, let's not use bonds. Let's use stock. Let's say they invested it in something like the next Facebook before they went public, and the shares went up 500%. How is that return divided? In a trust, usually what happens is all 500% belongs to the beneficiaries, and the trustee might take a fee for their services. Whereas in the insurance context, they might be that the insurance company pays, say, 20% to the beneficiary under a contract and keeps the rest of the windfall for itself. And the third one you want to look at is, are the assets in trust segregated from the beneficiary's assets? That is, if the beneficiary, in this case the employee, goes bankrupt, can his creditors seize the retirement benefits? Usually this one's not very helpful because many countries' laws have protection for retirement income, even if there's no trust arrangement. So you have to look look at a bunch of different factors, but I would start with this person that's holding on to the assets. If it goes bankrupt, can these retirement funds be seized by the creditors? That's probably the one that's most likely to give you the answer. Okay, now let's look at the Hong Kong Master Trust Scheme. Here's how it works. Hong Kong has this law that's called Mandatory Provident Fund, where everybody who is working as either an employee or a self-employed person has to contribute to save for their retirement. And the Master Trust Scheme is a type of Mandatory Provident Fund. What happens is participating employers, more than one, and possibly self-employment persons, they come together and they hire a private financial institution of some kind and say, hey, can you help us invest and manage these retirement funds? The participants are the employees and self-employed persons in this Master Trust Scheme, and there are mandatory contributions from employers and self-employed persons. The Master Trust Scheme is arranged as a trust under Hong Kong law, and in this respect, it is descended from the UK common law, meaning these will be trusts under trust law. Now let's look at, is it a trust? Well, you might have guessed the answer is yes, but here's how you go through the analysis. So number one, do we have a trustee that takes title to the company? The answer is yes. That's the financial institution. Is it to conserve it? Yes, for retirement. Is it for beneficiaries? Yes, for the participants in the scheme. And is it under ordinary rules applied in chancery or probate courts? The answer is yes, because this is a trust. So yes, this Master Trust Scheme is in fact a trust. Just as an aside, there are two other types of mandatory provident funds. One is called an employer-sponsored scheme, which is basically a single employer arranges for it. It's for big companies, whereas the Master Trust Scheme is for smaller companies and self-employed persons. The other one is called an industry scheme, where things like caterers, hotel workers, and those kind of people with very high job mobility, for lack of a better word, can participate. And these two are trusts as well, but we won't be talking about them during this session in any more detail. But just keep in mind that they exist. Now let's look at the UK SIP. Here's how it works. The employee goes and opens a SIP. It's a contract strictly between the financial institution and the employee. But both the employee and the employer can contribute to it, and the contributions between them are by contract between the employee and employer, usually in some salary sacrificing arrangement where the employee says, hey, contribute 5% of my salary to it, and the employer says, okay, I will match you pound for pound. The pension benefits will be limited to what is in the account balance, but the employee at retirement has the option of either converting it to a drawdown plan, meaning I can take it as much as I want as long as it doesn't exceed the balance, or they can convert it to an annuity, meaning basically the SIP uses the account balance to buy an annuity that might exceed the total balance later, but it'll be by actuarial and on the market. The employee has sole control over the SIP. The employer has nothing to do with it and can't do anything to it other than contribute. So, is it a trust? The answer is yes. The UK pensions are also arranged as trusts. So there is a trustee that takes title to property. It's to conserve it for retirement for the employee who created it. And it'll be under UK trust law, which are very similar to US trust law. So yes, we have a trust. Now that we know some of these are trusts, let's look at whether any of them falls into a special category called employees trust. So here are the issues we have to discuss. Is the trust an ordinary trust or an employees trust? If we have an employees trust, is there any portion of the trust taxed to the employee as if he owned the trust assets directly? And if it's an ordinary trust, is it a foreign grantor trust? Foreign grantor trust is a legal jargon. Foreign means it's controlled outside the U.S., which these pensions will almost always be. And grantor just means the trust is the income of the trust is taxed to a specific person as if that person owned the trust assets directly. So, employees trust or ordinary trust? As far as I can tell, there is not anything that specifically says this is what an employee's trust means. So we have to take context and how the law describes employees' trust to infer what it means. Here are some quotes under the Internal Revenue Code, which says, for a pension plan to be a qualified plan or a qualified employees trust, the plan must be established and maintained by an employer to provide benefits to its employees. This is the description after the Employee Retirement Income Securities Act passed in the 1970s, ERISA for short. Before ERISA, the definition, interestingly enough, is still preserved in the Treasury regulations. And for a trust to constitute a qualified trust, it must be part of a pension or some other plan established by an employer for the exclusive benefit of his employees. Interestingly enough, it does not require the employer to maintain them. But pensions are not strictly a tax thing, so it's primarily a labor law thing, with tax really to provide economic incentives for creating these plans. And under labor law, an employee pension benefit plan is established or maintained by an employer or by an employee organization or both that provides retirement benefits to the employees. So here's how I interpret the term employees trust. Right now, that is, plans established after ERISA, if you want to say it's a qualified employees trust, it must be established and maintained by an employer and also meet a bunch of other rules in the Internal Revenue Code. But if you want to say this thing is a non-qualified employees trust, it must be established by the employer or an employee organization, but it does not necessarily need to be maintained by the employer. So, how does that apply to Swedish ITP2s? Well, that's not a trust, so we don't need to worry about it at all. How about the Hong Kong Master Trust Scheme? Well, participating employers establish the trust, and participating employers maintain the trust, and it's open to the employees of the participating employers and self-employed persons. Seems to me that meets perfectly the definition of employees' trust. What about the UK SIP? Well, the employee arranges for it, and the employer has basically nothing to do with it other than contributing money to it under a contract. So it's probably not an employee's trust. We have another question, which is, please discuss this related to Australian super plans, including self-employed individuals. I'm going to decline to discuss this one because Australian super plans can be established under many different circumstances, including under a mandatory superannuation guarantee or by salary sacrificing arrangements between employer and employee, or by something the employee opened and then asked the employer to contribute to it, or just because the employee felt like saving some money at some point and opened one. The Australian superannuation crosses several different U.S. tax classifications because of the way how flexible they are, and I deliberately avoided them because I'll be talking about it might not be what I described in the slides, as opposed to these other types of plans where there are really only a few types of possibilities. So no, I'm not going to go into Australian superannuation in detail here. Sorry. All right. So what about rules for taxing trust income to the owner? Well, the trust, if you have an ordinary trust, the trust income can be taxed to an individual as if he were the owner of trust assets. And the rules for ownership for ordinary trust, they're in sections 672 to 679. Here's what it says about qualified employees' trusts. It's not taxed until distribution. That is, the trust can earn income and it's not taxed to the employee until they receive a distribution. So no ownership. For non-qualified employees' trusts, there are some special rules for ownership, different from ordinary trusts and qualified employees' trusts. So first we'll have to decide, well, we know it's an employee's trust, but is it a qualified plan or not? Technically, if you look in 401A, you'll see that a qualified plan is organized in the US. So the first reaction might be, well, if it's foreign, then it must not be qualified. That's not quite right. The code actually hides another provision in section 402D, which says if a foreign plan meets every criteria for qualification except that it's organized outside the U.S., then we'll treat it as a qualified plan. So yes, foreign plans can in fact be qualified plans. But if you look under the qualification rules under 401A, you'll see 37 paragraphs detailing what it means to qualify. And if you read them somewhat closely, you'll see that there are references to other code sections, internal definitions, and a bunch of others. So it's not very easy to be a qualified plan, and these are rules that Congress wrote without consulting the other OECD countries, meaning if a foreign plan is not specifically advertised for U.S. citizens, then it's pretty safe for you to assume that the foreign plan is not qualified. if there's a lot at stake, you might want to look at the rules carefully and apply them to the plan, but the chances of qualification by accident is pretty low. So for this slide, I'll just assume these plans are not qualified if it's an employee's trust. So what are the ownership rules for a non-qualified plan? Well, the general rule is that the employee is not an owner. But the IRS does not want the employee to just take a shell plan that the employer established and then just stuff it with money and defer tax on the income. So the Treasury regulations has another rule which says if the amount of employee contribution in a non-qualified employee's trust exceeds the employer contribution, then the employee is treated as the owner of the employee contribution portion. Notice that this only applies to the portion attributed to employee contributions. So for example, if you have a plan that says, I will contribute £1, where the employer says, I will contribute £1 for every £2 you contribute, what happens is the employee will be considered the owner of only 2/3 of this plan, not the 1/3 attributed to employer contributions. And trusts can be bifurcated like this, so be careful when looking at them. The Swedish ITP2 is not a trust, so we don't have to worry about this. The Hong Kong Master Trust Scheme. We assume that it's not a qualified plan, so we would compare the employee contribution to employer contribution. If the employee contribution is greater than the employer contribution, then you have a portion where the employee is treated as the owner. How about the UK SIP? Well, it's an ordinary trust, so we apply the ownership rules for the ordinary trust in sections 672 to 679. I'm not going to list all of them, so I'll just tell you the sections that would make the UK SIP the employee and owner of the UK SIP. For employee contributions, there's section 679, which says, well, if you as a U.S. person contributes to a foreign trust and there's a U.S. beneficiary, in this case the employee, you're the owner of that portion. And for the employer contribution, you're looking at section 678, and this is because the employee can direct the trust to distribute its assets to his own estate. So the UK SIP is a foreign grantor trust, and the income is taxed to the grantor, or the employee, the owner rather, in this case the employee. There's a treaty benefit for this, which I'll discuss when we discuss reporting growth in the pension, but at least strictly under U.S. internal law, we have a foreign grantor trust. Okay, we are at a section break, and there's another question. So how do you get the information you need for each client's pension situation? Here are a few things. So here's what we do in practice. Usually the client tells us, hey, I have a pension in so-and-so country and so-and-so country. And then I do a quick Google for so-and-so country pension and take a quick look at how the pension system works in that country. This is kind of important because you need to know what kind of pensions they might have and what kind of arrangements they might have to get the right questions to ask. A lot of OECD countries, especially in the EU, they operate under similar rules just so to make it easier for people to move from country to country. but they're not exactly the same, and you really should do the initial Google process for what kind of pension. Usually what happens is and one thing you want to be careful about is most people will call their Social Security a pension, specifically a public pension. So if somebody says, oh, I'm getting a pension from Germany, there's actually a pretty good chance that they're talking about German Social Security and not what we're talking about today. So be careful about terminology. Most often, the terms you'll encounter are public pension or Pillar 1 pension, which is the nation's Social Security. Second thing you'll look at is occupational pension or workplace pension or Pillar 2 pension. These usually refer to an employee's trust sponsored by the employer. And the third one is private savings or personal pension or Pillar 3 pension. These are individual retirement accounts and usually are not employees' trusts or pension arrangements. But yes, different countries, different system. First Google it and then start asking based on what you find as to whether that person had which category the person's pension falls into. Very often you'll have to ask the client to say, hey, contact the pension manager and see if you can get the transaction records. The answer is usually no, and I'll address what we do in the reporting growth section. There's a second question, which is how do these rules apply to ISAs? Now, ISA stands for Individual Saving Accounts in the UK. And the idea is they're very similar to IRAs, where you open an account with a financial institution, you save money in it, and these have specific rules on how they operate. And then the tax on the income is deferred until the person starts withdrawing. ISAs are not pensions. They're just a tax-deferred account in the UK, and the US does not recognize it either under the treaty or its own law. So you just have a cash account or a plain investment account from the US point of view. So keep that in mind. Okay, here's the Swedish ITP2. If it's being funded by the book reserve method, you want to look at section 409A and see if the deferral will fail at any point. I'm not going to get into that in detail. If you are paying an employee insurance company for an annuity, the premium is probably included in income because I doubt the Swedish pension is a qualified annuity. And the premium cannot be excluded as foreign earned income exclusion. That's a specific exclusion in the code. Reported as wages on line 7 or whatever they modified the form to after the latest tax law changes. So what about employee contributions? There are no employee contributions under book reserve method. And for the premium, just there is a 1% excise tax if you pay annuity premium to a foreign insurer. And this is paid quarterly with Form 720, but it's waived under the Swedish-US income tax treaty. It's under the income tax treaty, not the excise treaty. Don't know why. It's not in every treaty, so be careful and look at every treaty when you try to claim this benefit. The IRS waived Form 8833 filing requirements for this benefit, so you don't even have to file that. How about the Hong Kong Master Trust Scheme? Well, we assumed that there were no contributions after our green card holder moved to the U.S., so under our assumptions, we don't have to address it. But if there were contributions, you have to include both employer and employee contributions in income, and it'd be wages on Form 1040, line 7. Again, there is a specific rule that says you cannot use the foreign earned income exclusion against this. Now let's look at this form called Form 3520. Form 3520 is a form used to report relationships with foreign trusts. One of the reporting requirements is that if a U.S. person contributes assets to a foreign trust, he has to file Form 3520 to report the contribution. And Hong Kong master trust schemes are foreign trusts. The IRS waived the reporting requirements, specifically for a 402B plan, so you do not have to worry about Form 3520 for contributions to these plans. What about the UK SIP? Well, again, we assume that there were no contributions while the person's a U.S. resident. If there were any contributions, both the employer and employee contribution should be reported, and it'd be wages on Form 1040. And because this thing is not a 402B plan or a non-qualified employee's trust, in fact, the foreign earned income exclusion does work against it. What about Form 3520? Again, UK SIPs are foreign trusts. There is a potential waiver that does not apply to every SIP, and I'll explain why. Suppose the employee created a SIP or already has a SIP and asked his employer to contribute to it. Well, the employer might offer this type of plan contributing to a SIP to every employee. If that is the case, this will be a broad-based plan falling under Section 404A, and this contribution is then excluded from 3520 reporting. But if the employee is some sort of highly valuable employee and the SIP arrangement is a special exception made for him, then you have a problem because it's not a broad-based plan, and suddenly Form 3520 would be required. Okay then. Now, let's look at growth. These plans will earn income, interest, dividends, gains, or other types of return on investment. So if the pension earns income, what about the employee? For the Swedish ITP2, if you have a book reserve method, you look at the rules for deferred compensation under 409A. And again, I'm not going to talk about that. For paying premiums to an insurance company, the general rule is growth is not taxed, and when distributed, it is taxed as an annuity under Section 472. But you want to be rather careful. You want to be rather careful that this annuity is in fact an annuity. And what happened was, I think back in the 80s or before the 80s, insurance companies started selling so-called insurance or annuities, where they basically said, oh, an annuity contract, and give you a nominal payment out of the annuity, and then let you invest in a bunch of funds or stocks or bonds or something through the annuity policy. So these kind of plans, so Congress did not like insurance companies selling a wrapper and deferring tax on investments that way. So they made a diversification requirement for the annuity. The idea is if you have so few investments that you can basically count them on one hand, then you're not really selling an annuity or an insurance policy. You're really just giving the holder the benefit to the investments. So you want to check these diversification requirements to make sure that, in fact, this annuity is an annuity and not some kind of disguised investment account. Also, there is a look-through rule for the diversification requirement. So if you see a fund, a single fund in the annuity, and the fund matches the name of the financial institution, check that fund to see if it's publicly traded. If not, you can get look-through diversification through that fund. So, but if you check it out and it is in fact an annuity, then the growth is not taxed or reported. So, how about the Hong Kong Master Trust Scheme? And for simplification, we'll assume the employee is not the owner of any portion of it. So the general rule is employees is not the owner, so the employee is not taxed on the income of the trust. But there's a special look-through rule for things called passive foreign investment companies, or PFICs for short. What are PFICs? Well, it's a foreign corporation that satisfies at least one of two tests. The income test, which says 75% or more income is passive, or 50% or more assets are passive. There are a bunch of ways a company can become a PFIC, but in the context of pensions, it refers to things like mutual funds, exchange-traded funds, hedge funds, unit trusts, these publicly traded or sometimes privately held pooled investment vehicles. It doesn't refer to a money market fund, and the reason for that is the money market fund itself is a PFIC, but usually investors in them have a debt relationship with them rather than a share relationship. So yes, money market funds are PFICs, but usually investment in them aren't. What does the look-through rules say? Well, PFIC shares are treated as proportionally owned by the beneficiaries under a special look-through rule, and this is different than the rules for owning trusts. The regulations provide an exception for qualified employees' trusts, but not non-qualified employees' trusts. So we have a negative implication here. We have look-through for non-qualified employees' trusts. And in this way, often the result is there's a backdoor look-through rule where, yes, supposedly the trust is not, income is not taxed, but PFICs. How do you account for these? Well, ideally, you want to get the transaction data from the pension manager and then report individual fund transactions on Form 8621. But reality hits, and if you are a participant in, say, a 20 different employer master trust scheme, or you participate in an enormous multinational company's pension fund, they're not going to tell you any transaction data. So we take some shortcuts if data is not available. And we just assume there's only one PFIC, or maybe one PFIC per sector of investment. But do try to get the data from the fund before using the shortcuts, and then document your file saying, we tried getting the data, they refused, and here are the communications, and attach a statement to Form 8621 explaining what your shortcut is. We are at a section break, and we have some questions. Is a 3520 required each year for a UK SIP if no contributions are made? I am going to get to this right now. Second question is, employer pension contributions would fit into the general basket for FTC purposes on 1116. How about when this pension is distributed? Would this income also go into the general income basket? The rule is not that clear on these, but actually a bit of background. So if you want to take a foreign tax credit for taxes paid to a foreign country, you have to divide your income into general category and passive category, or the general basket and passive basket. And you have to split the U.S. tax into tax on general and passive category income, and also foreign tax into these two type categories. And you have to match the categories. So annuity is a type of passive category income, and the distribution from a non-qualified plan is an annuity. So my take is that it's actually in the passive category when it comes out. I don't know if that's the correct answer, but that's the best interpretation I have based on the text. If you know a better answer and the source, I am very open to revising that conclusion. So for the UK SIP, the employee is taxed as the owner, but the treaty protects the employee from tax on the SIP's income. This treaty protection applies if the person is either a U.S. resident or a UK resident under the treaty. But if you want to claim benefits as a UK resident, just be careful that it can cause tax expatriations for a green card holder. And again, Form 8833 filing requirement is waived because it relates to a pension. Now, getting to the Form 3520 and in this case, Form 3520A. Form 3520A must be filed annually if there's an U.S. owner of the foreign trust. The trustee is supposed to file it, but the owner can file a substitute. And a U.S. owner must file Form 3520 annually if he owns part of a foreign trust. What happens in the context of a UK SIP? Well, the IRS has waived the 3520 and 3520A filing requirements for Canadian RRSPs based on very similar treaty benefits. They haven't specifically said they waive it for UK pensions, but when they did waive it for Canadian RRSPs, what they said is, if you file 3520 and 3520A, you have to keep filing them and include the income of the pension in yours. I take that to mean that you don't have to file the 3520 and 3520As for UK pensions based on the treaty, but that's not something the IRS specifically said. It's just based on how the Canadian rules evolved. I think there's an implicit waiver, but if you want to be cautious, you would file the 3520 and 3520As for the SIPs annually. Just bear in mind that if you do this, the taxpayer may end up having to report income of the SIP every year, even though a treaty benefit would have been available. Difficult decision, but yes, lack of IRS guidance, unfortunately. What about distributions? Well, here's the Swedish ITP2. It's just taxed as an annuity or a pension. If any part of the distribution was taxed as premiums, it's not taxed again when it comes out, and the rules for apportionment are in Section 72B. Report on line 16, which is for pensions and annuities. For the book reserve method, you want to account for amounts that were previously taxed under 409A, so you don't get double taxed. By the U.S., that is. There very likely would be double taxation if there were accelerated income, just because under Sweden it's deferred until distribution. Now, how about the Hong Kong Master Trust Scheme? So when you have a non-qualified employee's trust, and when the amount is distributed, it's taxed as an annuity. Again, report on line 16. The post-tax contributions are not taxed again. So, for example, the amount that were taxed when coming in, when the employer put it in, well, fortunately, you get an apportionment that avoids that kind of tax. Form 3520, you have to file this if you receive a distribution from a foreign trust, but the IRS has waived this requirement for a 402B plan. 402B plan being a non-qualified employee's trust, and therefore no Form 3520 required for this Hong Kong Master Trust scheme. How about the UK SIP? Well, the rules are not very clear. There is kind of a cute text reading where the distributions are not taxed, but don't use it because that almost certainly won't work. But the most likely result is distributions will be taxed as an annuity under Section 72 because of the treaty protection, and again, line 16 of Form 1040. One thing you want to keep in mind is the UK allows a person to take 25% of their pension pot value tax-free. If the beneficiary is living in the U.S. while he takes that 25% tax-free distribution, the U.S. actually has to exempt that from U.S. tax under the treaty. The treaty claim is for Form 8833 is waived. I prefer to attach the 8833 because usually this will be kind of a big amount and it'll hit his bank account. So not required, but maybe a good idea to just file it. All right, so what about Form 3520? UK SIPs are foreign trusts, and unlike for contributions, broad-based plans under 404A are not exempt from reporting when there's a distribution. So regardless of who funded this plan and which employees are offered SIP, whether it's broad-based or not, the text actually says there is a Form 3520 requirement. Again, rules are not very clear on whether the treaty there are implicit waivers under the treaty for this reporting or not. So if you want to be cautious, file it. Just be careful that the IRS will come back and say, well, you treated this as an ordinary trust, you have to continue to do so. There's another point of not very clear, which is if you receive a distribution from a foreign grantor trust, line 29 of Part 3 of Form 3520 says you have to attach a foreign grantor trust beneficiary statement. That is page 4 of Form 3520A, and usually the trustee won't file this Form 3520A, so the owner has to file a substitute, and it's not very clear whether you can use the substitute to issue the beneficiary statements. So again, not very clear. Okay. That comes to the end of our presentation, and here is the disclaimer. The presentation is not legal or tax advice. You can't use it to avoid penalties. Please hire someone to help you on the subject, maybe us. And we do have one more question, which is, are SIPs reported on the FBAR and Form 8938 if Form 3520 is not filed? The answer is yes. All right, then.
Yes. And I'd like to thank Haojin Zhang and everyone at Hodgin Law and everyone attending online. Certificates of completion will be available for download within 3 business days. Thank you all for joining and have a terrific day.